we have to look for new solutions to beat the market, and we can't predict the small changes every day. We can't predict that tomorrow the prices will go up or down, because we see, for example, on the left photo, that it's just unpredictable. But in the long term, we know that the trend is just that everything's just grows. Yeah, the index, S&P, NASDAQ, and every other big indexes, right? So we focus on the long-term investing, not the short-term. That's what we know. And the trap which we usually are the trap is that we can't just investing in the low PE stocks, because there is a reason why there is a low PE, right? And so what is the solution for that? And maybe just about safety more, because the safety is not the biggest when we are choosing the low PE stocks. And as we see, the results are similar to the S&P 500. And the max drawdown of the stock prices is sometimes even bigger. We don't know how much it will react, but we know that in the long term, it's just not the best solution to choose just the most, the lowest PE stocks. And yeah, PE and PE to price to sales ratio, right? But the one factor which makes the stock in the long term just grow in a very fast time is just the growth and the profitability stocks. So we are looking for companies which grow in a quick time, right? They are every year they are just forecasting for higher and higher profitability and growth, and that's the way to outperform. And we are focusing about, for example, more than 5% annually revenue growth for forecasting for next 2 years. We are looking for this more than 5% for forecasting for average estimates for 2 next years. And the same with the EPS growth. The operation margin should be 20% or more. Cash from operations also they should increase 10% annually. ROIC and ROA should be more than 15%. This is not what I was using in my model, but this is the base stuff which we should start when we are making back tests, making scoring models, because it just shows that company is working good and the industry is good, for the future it will be just growing and growing, and this is not the business which will die in some 10 years or something. And we see that results are very good in the long term when we are just choosing profitability driven portfolio. And you see that we are, for example, there is 25 to 30 companies. I will explain later why this is many investors which are using back tests and model portfolios. They are usually choosing 25 to 30 companies in the portfolio. I will explain later. And for example, we have one example of NVIDIA. Why the stock price was so big, and it's not because of the hype, it's not because it's a bubble, but we see that after 5 years the revenue growth was 1000%, net income growth was 2000%, cash from operations growth was 1380%. So it's there's a reason why the stock is that much it raised that much, and it's even like it grows even more than the stock price. And we see that when we create a portfolio based only from the profitability, we will make a very good return in the long term, but max drawdown of the portfolio will be bigger. But when we will make like profitability filter, but with risk filter also, we will make a little bit less return, but max drawdown will be also less. So it's always something for something, right? And this is, for example, from the investor which I learned from. That was his 5 basic criteria to to make sure that it's safe. Like it's just this risk filter that he was using, for example, to make sure that the company will not bankrupt or something. For example, Olson bankruptcy score. This is I'm using this. I don't know if you know what it is this, but it's multiple like indicators just in the one indicator combined, and for example, I'm using 5%, and every stock has some number. For example, annually, it's, for example, 2% of probability that this company will bankrupt. And I'm using like more or less than 5%, for example, in my own model. And why 25 to 30%? And this is it's not the best graph, and it should be portfolio risk, and it should be like high the risk, and it should be low here. But there is a guy named Harry M. Markowitz. I don't know if you know them. I don't know if you know him, but he created. He got a Nobel Prize for creating this modern portfolio theory. That when we have one stock, it's a very big risk. But when we are making, for example, 10 companies, the risk is much lower. But at some point, there is no difference between, for example, 40 or 50 stocks, because it's not like, it's just.
This is very interesting.
And it's going to this level, and it just stops in some point. And we just want to find the good spot to make a better performance, of your portfolio, to beat the market, and to have some risk, to just low risk. But it's not the lowest risk. The lowest risk would be to choose 40, 50 stocks. But also, it's about that here we have, for example, big chance of beat the market, but also risk is high, right? But when we are going, for example, here, or here, the risk is lower, much lower than here, closer to this, but the probability of beating the market is much higher. So every like investor which knows about it, about like maybe he graduated the investment study or something, these guys just know that this is a good spot for having 20, 25, for example, stocks in the portfolio. And how we should weighting about your portfolio. We shouldn't weight them like equally, because the volatility of every stock is different. And for example, Microsoft, for example, it's 14, but for some other company it will be 40. Or so the position of this more volatility stock should be lower. And this is also some portfolio managing theory. I will just show you later about it. But
so low volatility, bigger weight, high volatility, lower weight.
Yes. And this is from the hierarchical risk parity. This is the name, and it showed. It's more complicated. I will not explain right now. You can just write this and Google it. But it's about like from which industry, from which sector is the company, and checking the price stock for for some time, and it's just calculated how much the also about correlation stocks. So you are checking the correlation between stocks, also the annual deviation and the sector industry, and you in this in the on the website, which I will show you, it's automatically done. It will calculate for you, for example, how it should be how it should be allocated. And for example, hierarchical risk. Yeah.
Sorry, I don't mean to interrupt. I'm just wondering if I could ask a quick question.
Yeah, sure.
Just curiosity, do you use the PEG ratio in your calculations? Because that's one I was thinking of using more.
Yes, I'm
You do
using
use PEG, okay.
I will explain later more.
Okay,
So,
thank you.
for example, for many back tests which I was using, the hierarchical risk parity was better than equal weighted portfolio because it has a bigger CAGR, total return, and volatility is just lower, so it's better. Yeah, and I think that's it. I will just show you how to do this on this website. And this is Scrap. I will maybe show you the basic website. You can create a free trial. You can just make just click the login and create the free account for 7 days, and you can check many things. You don't have to show your card number, anything. Just put the mail address and you can use it for 7 days. And even after these 7 days, there's many things which I'm using still for free. But for backtests, I'm just using the new account. As you see, I have number 6 right now. And I will just show you how it works. We have few things which we can do. We can screen there. This is the screener, so we can find the stocks which fit our criteria. And this is the stock screener. And for example, I saved some of them. For example, this one. And I'm choosing, for example, companies from USA, market cap under 5 billion, price under 5, not penny stocks. And there is many companies which will be there. And I can, for example, choose all of them and put to the sum of the scoring model which I created before. I will show you now the scoring model which I created. We can create the scoring model from the rules which are like saved in this program. You can just search what you are looking for. You can look for many indicators. You can use it for checking the free cash flows to price. You can search for forecasting the revenue and everything else. But you can also build your own indicator, and there's like few types of them, and it's based on the because usually the platforms, financial platforms, are showing you, for example, that P/E ratio right now is 20. But the reason I'm using this is because I can compare the maybe I will just look for P/E ratio, right? And I'm choosing the P/E ratio. It's here, and I'm for example checking the Broadcom. Okay, and we see how it the P/E ratio historically, and that's very useful because we can't just look for the P/E ratio like comparing for example, two companies from the other sectors, and we compare the P/E ratio. We should look also for comparison to the same sector company, the same industry, but also to the historically results, you know, of this company. And for example, I'm choosing P ratio and I'm choosing the 3 years median, and I just can compare. So 3 years median shows that this is like a average. Now is the average place of this for this company. But P ratio is just basic one. More later, I just start using P ratio forward. We have 1 year forward and we have 2 year forward, and I can just also compare how it looks, and it shows that now it's cheaper than usually. This is the basic the basic explanation of how it works. But for example, I was very surprised because this guy, which I was listening for he told that the Broadcom is expensive, but we can look for PEG, which you were talking about, right? And for example,
Yeah,
when we
see
are
that.
looking for PEG ratio 2 year forward, this, and what is this? This is PE ratio 2 year forward, and we just compare
EPS
this to
growth.
the
It's over EPS growth.
we
I
compare
think.
to the EPS growth to we compare to the growth, EPS growth percentage, because we can also, I will show you, average estimated annual growth. I'm using this many times, and I can just see how it's like analytics, you know, they are forecasting the growth of EPS, you know, and we see that they're forecasting that in 2 years, average for every year, it will be 37% of EPS growth. And when we are comparing, EPS growth, sorry, I just lost, sorry, but PEG ratio is very useful because we can compare to the growth of the company, and we will see now that it's very cheap historically. So usually we are just not seeing that, you know, because we don't have a tool to check these informations. And this is of course for 2 year forward indicator. And I was using many of these indicators to create my scoring model. And also I created something like PEG, but I created PSG ratio, which is not about EPS, but about price to sales and growth ratio. You understand? It's about sales, not income. And it can show you also interesting thing that it's more cheap than usual.
Okay.
But this is the option which is like not free. I just bought the advanced version of this program to create my own indicators. And I created, for example, this, and I created also P3G score, which is combined PEG ratio, PSG ratio, and I also used this to create like free cash flow to grow, to free cash flow growth, if you understand. And I combined everything into one indicator, which shows me how it's like how cheap the company is compared to the growth of this company, you know, the revenue, the income, and the free cash flow. But I will show you maybe just my portfolio. I created the scoring model, which makes 20%, 0.15% annually from 2006 to 2026. Are you with me? Do you hear me?
Yep.
Okay. And in this backtest, I was using S&P 500 companies from this period of time when this rebalance, you know, the rebalancing was made. So it's not like S&P 500 how it looks right now, because it would be stupid, right? Because we know that these companies won because they are still in the S&P 500.
Mm-hmm.
And where is the
Right. The S&P itself, they change every 3 months, right?
Yeah,
So-
yeah, and it's and it's included here that it's changing the S&P 500 how it looks. I will just show you. I created basically this 20. There should be 20 indicators. I created price to free cash flow, and I gave 15 points maximum for that indicator. And I created if the company has 200, which is like not a very good result, but some tech companies, for example, can have this 200, and some companies which we are very often looking for, like cheap stocks, they can have even 8, right? And it's calculated. Maybe I will just Oxy, for example, got 14.74 points for that because price to free cash flow is 11.3 in this example, and for example, Nvidia will have 58, so it get 11 points. You understand that?
No.
No.
Take me through that again.
Yeah. So this indicator, we are using price to free cash, price of the stock. The stock
Yeah, I understand
market
that.
cap,
Yeah.
Combined. This is combined. Yeah,
Mhm.
to by free cash flow. So, for example, if company has 8, that means if we multiple 8 by free cash flow, it will be the price of the company, right?
Yeah.
So 8 is the best. For example, I choose that if the company hits 8, the company will get 15 points maximum for this parameter.
Got it. Okay.
Yeah, and the
You want
200 is just the worst, right?
the
For
ratio,
example.
if the ratio is smaller, it's better. That's
Yeah, in this example, because in the scrap it's like this, price to free cash flow. So I had to set it like this, that 200 is the worst. And if it has 300, it's the same. And if it's 4, it's also like the 15 points. It's not better when it gets 4 than 8, because 8 is the best, for example. So you understand now?
Yes.
Okay. Okay. I don't know. I never explained it in English. This kind of things, even in Polish. Okay. Second thing is comparing price to free cash flow compared to the 10-year history of this indicator for this specific company. So, for example, we have Occidental. Okay. Now it has 11.32, but there was a time when it was much higher. So compared to that, now it's much better, right? But I used also this is something like horizontal channel. If I will turn it on, it will be like straight lines. If it will go to the green, it's just good. To the red, it's bad. But when I was not using the horizontal channel, it just looks for the 10-year average from the time, and it creates the channel, I don't know how to explain that, but the trend was that it's going lower and lower, right? So now it should be just in this spot to get some points, but now we are not going down like this trend was going, so it will not get any points. And I was using before the horizontal channel, which is like base, it's just this level bad, this level good. But the results are better when we are using horizontal, when we are not using horizontal channel, because it shows the trend for this company, and it just works. I just found out that it works. The same is like with P ratio. Sometimes the company will be cheaper and cheaper, but it's not always good, because the price, for example, will be cheaper and cheaper also because the industry is not good anymore. The investors, they don't think it will be a good company for the future. So we are just looking for the trend, for example, here, and now it's on the high end of this trend, it's got 0 points. Sometimes it's, you know, cruel for that companies, but it's just mathematically proven that it's good when you are looking. For example, in NVIDIA, it will have this trend like this, and it's cheap right now. For example, for if we are based on free cash flow, of course we are not checking this like you're checking for this DCF, yeah. Yeah, and this is the other way, yeah. We are not checking because maybe it was always like too expensive, this stock, but compared to history of this stock, now it's cheaper, right?
Mm-hmm.
We are looking, because I don't have a free cash flow growth in this website. I'm using CFO growth. It's almost the same. You know, it's like cash from operations.
Mm-hmm.
And I'm checking here, it can get 8 points maximum if it's 30% annually growth forecasted for 2 years. So every year 30, if it's growing, it will get 8 points. And 5 points is just the lowest number it can get. Or for example, NVIDIA has 58% forecasted right now growth,
Mm-hmm.
right?
Mm-hmm.
We also have compared to the history. Every parameter which I was using to check it, like, you know, from the checking like just two kinds of things. One is just checking this is good, this is bad, and the second one is checking compared to history of this stock.
Mm-hmm.
And for example, for CFO growth, it will be good if it will be in this spot. For example, for Oxy, now it's in the middle, so we'll get something like you know, in the middle of spot.
Yep.
And it's 5 points. And it's the same, for example, with revenue average growth for 2 years. I created 20% is the best and 8% is the worst. Also, compared to the history of this stock, based on the channel, this is like 10-year channel. I can change it to, for example, 5, and it will look different. But I just want to have it longer to make more, to make less mistakes, because for shorter time it can be, you know, very like almost like this, the channel. So I want to it just more make less mistakes. So I created for 10-year channel. And the same with EPS growth. I just, you know, I was just checking how many percent it should have for the maximum points. I just found that this is a good spot for me, and it works good in the back test later, which I was making. So I'm checking these 3 things basically: free cash flow grow, revenue grow, EPS grow, and EPS grow for 5 years, estimates for 5 years, because there is an option in Scrap to check the analytics forecast for 5 years. So I also included, but with less points, because it's more, you know, like you never know how it will behave in 5 years. But I included this also compared to the history of the stock. We have valuation part, which is just P ratio. It's just 40 is the worst and 10 is the best, just to make you know, maybe because maybe it will be a very good company with very good growth, but also with good P ratio, so it will be a bonus for that, for 5 points. Oh, this should be in the other category, but oh, it's okay. This is PEG ratio, and this is just to make sure it gets 0.1 points, because I just wanted to make sure that the company doesn't have 0, because that means something is wrong. You know, the growth will be on minus, or usually, yeah, the growth will be on minus, right? The average growth estimates. So I wanted to make sure that it's just more than 0. So I created this, like you see here, the shield, that this is the must-have. This is the must-have. I just marked it here, that this rule is just must-have, and company will with 0 will be just out of this model. We have P/E ratio lower than 3-year median, for example. So the P/E ratio has to be lower than median. Just to, it's not like obligatory, it's not must-have, but it just gets points, right? Also with P ratio lower than 3-year median, just Oxy had 0 points. We have cash from operations to depth. I was using 18. It's like more optimistic. I just didn't want to. I didn't want to get rid of companies which are very like growing, high growing companies, but they are just maybe they have too much depth. Because when I was when I was making more rigoristic categories in the financial health, I just find out that the total portfolio didn't behave that good, ironically, but it's just basic, protection. This 18 cash from operations to depth. And some companies, they are like very close to this level. For example, yeah, like Occidental can't fit here. For example, Amazon, it's like 23. It's not very good. We know that they are investing in data centers, right? That's why NVIDIA has 2.19. So it's like this. Low bankruptcy probability. This is this Olson, I don't know how to pronounce it, but it's this Olson score bankruptcy, which is combines many indicators in the one. And it just shows me that, for example, for Oxy, it's 0.5% of probability for this year that it will bankrupt in the next, like in this year, right? In the 12 months. Based on, I don't know, depth, free cash flows, many things. NVIDIA, I think, is very 0% of probability. And Olson score. This is very similar, but it's not in percentage how probability is, of the bankruptcy, but just the lower is better. So I just made possibility for very good companies with very, like the lower is the better one. So I created, just that if it has -10, it's 4 points. And just 3 last things, just market cap from 1 billion to 30 billion. It's just, I wanted to give more points for bigger market cap, to make just it more, because they are more safe, they stay more stable. So I wanted to put more points for bigger company. Like if it gets 30 billion, it gets 5 points. But if it's below 1 billion, it will be not in the portfolio, because I marked it's like must have. It has to have $1 billion, right? Market cap over 300 billion, I just put 1 point extra for being, like a very big company. And not a penny stock, so it's not under 5.
Right.
And it's must have. And that's it. And then I just, when I created this, we can switch to the scoring models, and it's just right here. We can see many companies which I put here there's like 1,171 companies, for example, and I can check how it looks for every company. And for example,
and these are all companies that qualified into your process.
Not every, but I just, for example, from the screener, which I told you, I was looking for companies, and for example, every company which it looked for, which fits this criteria, I added to this model. And then when I went to this model, I have these companies here from this screener. Do you understand?
Yes.
Yes, and this is like total, you know, the total, just the higher is better, you know. This is, for example, the local is the first one. But in the back tests, which I will tell you later, I just used 500 S&P 500 stocks. This is just for research, you know, for checking things. When I will just check, for example, NVIDIA, I can check how it behaved in every criteria, how many points, you know, it get. And I can, for example, compare this total score for NVIDIA to company peers. You know, like I can just check that Micron had also good results, AMD, and these companies had a lower score. And I can check the scores history for NVIDIA. So I can see, just it will load. I can see that, for example, median total score for NVIDIA was 71. Now we are 78. So now it's better, right? In the history. We can check many things. How the free cash flow was. It's all based on my model, right? It's not just created on some other things. Just about my indicators, which I was and categories which I was creating. Okay, so.
Piotr, could I add something very
quickly?
Yeah.
Maybe you have a question because there's many things, and
Well, I don't have a question myself. I just wanted to add something. It's something that I actually just realized, and I also realized I hadn't thought of it before, which is a little surprising, because you were talking about choosing companies or limiting yourself to the S&P or not limiting yourself. And I realized, wait a minute. Is the S&P, because you can have companies outside the US listed on NYSE and NASDAQ, of course, as we know, right?
Yes.
Alibaba, DLO, etc. But I didn't realize till I just Googled it, S&P 500 is only US domiciled stocks. Now, maybe you know, maybe you don't. Maybe we kind of like assume it. But yeah, that could be limiting.
Yes, that's why also there's other option. We can choose not to source of companies from S&P 500, but we can source them from our screener. And we can, for example, choose not only USA, but here I chose not to only company countries from USA, but exchanges. So there's also like TSM, right? ASML. And we can make a backtest using this screener for like also historically how it looked. You know, the results of this screener, not right now. So we can make also backtest from our own ideas, you know what I mean. For example, I will just mark it like this, and it will, in the 2006, when the backtest began, it will search the companies which were in the USA exchange, but I can use, other countries. And it will just look for in the companies which fit this criteria in this time. Do you understand?
Oh, yeah.
So, but it's only in the advanced program of, it's not in the free trial. I had to bought it to test this. So, for example, you can have many criterias also, like, ROE, I don't know how to pronounce it, but
ROI? No.
ROI, sorry.
ROI,
for example, many criterias you can put here. Free cash flow, price to free cash flow, many things, and you can just use this screener for your backtest, for example. I just wanted to show you basic from the S&P 500, but I made also different calculations, and they were even better. For example, when I didn't choose only companies from USA. But just going to the backtest, how it looks. Wait, I will just show you. For example, it looks like this, that we are choosing the scoring model which we created, which we want to use in the backtest. So I, for example, want this, which I created. And here I use companies which we are looking for, like from which source companies. And I can choose historical S&P 500, But I can, for example, choose the save screener. So this is what I was showing you, the screener, and I can save it, and now I can use this screener for the backtest. And just the period from when to when I want to make this backtest. Later, it just calculates for 10 minutes because there is many data to calculate. And later I have something like this. This is the backtest screener, and I just choose the time from when to when. This is the rebalancing frequency. If I choose, for example, 3, that means every 3 months will be rebalancing, right? So not only selling because the price is higher, so we want to change this, the weighting of the portfolio to be the same like in the beginning, but also checking the scores of every company. And maybe some company now it has the lower score, so it will be sell, and we will buy a new one, right? With the better score. And I just found out that 3 is good for my own portfolio. And portfolio size, I chose 5. I was testing 10, 15, 12, 20. For some scoring models, the best was 20, for example, 20 companies. But for this one, the 5 was the very good result, and the volatility was not that bad, like max drawdowns of this portfolio. And I choose, for example, this is like asset allocation. How much, of which company we will add. We can choose equal risk. It will calculate the risk of every company and will just show us how much we should bought, of every asset. Equal weight, but it's not the best option. Hierarchical risk parity. It's similar to equal risk, but it's just more advanced, and it generates the better results. And I just chose proportional to metric, and I just chose to which metric, and I choose that PSG ratio. So it's like PEG ratio, but from the revenue side. Do you understand?
Yeah.
But 2 years forward. So if the lower PSG is, it will get the bigger position in my portfolio. Because if I will mark this one, it will this will be if PSG is higher, it will get bigger position, but I want lower because it's better. And I just mark this correlation adjusted. So it also calculates the correlation between stocks and also, show me how much I should put for every company based on PSG ratio and correlation of every company. And this is this is what you are always saying, Victor, required years science PPO. So you can choose this guy, which I was looking for. He was using 3 years. I just choose 1 because there's many good companies which are good.
3 would be too high.
Yeah. So I choose 1, and there is tolerance for low scores and missing data. So for example, for some companies there is no full data available. For some indicator, I don't know how to show that, but some companies will not have every data available, and the program can't verify this. How many points should get. So if I will just choose low tolerance, it will mean that if some data is missing, the company will be not included in the portfolio. I choose the medium tolerance, so not full, because if there will be full, there's many companies which doesn't have many informations can fit in the portfolio, because there is few just indicators which will be checked, right? And we just want to make sure that it's almost every indicator is available to have a score in the model. I'm not using this because it's more advanced and I just don't have good results with using that. This is, when we buy a company, for example, if total score is greater than some points, I'm just not using this. You can play with it, but I just don't use it. And I just use the last section, which is you just can puts how much in the beginning of the backtest, how much money we have when we are starting, and reduce portfolio turnover. So that means if there's two companies, for example, one has 80% of the total score and the second one has 79.5, there will be no change in the portfolio because it's like more, like money to pay the tax and the gain. When we have to create some also the pay for, we also have to pay for selling and buy a new stock, right? The provision. So if there is a very tiny difference, we are not switching the companies in the portfolio. And when I changed that, when I checked these results, I had like, this is the profit, and I will show you the open tier sheet.
And that's compounded over 20 years?
Yes. But I will show you more interesting things which I find out that we can check even. We can check even every 3 months which company it bought, for this period. So we can check how was the logic, for this model. And we see that it's like this. For example, for 1 year, we have 79%. In every backtest, I have the different results because I changed something different, one thing, for example, and it's different.
Did it tell you like what was the average time it held the stock?
I don't think so.
Like, did it stick to Apple for like 6 years?
No, I think I have to do this manually to just check. I will just show you. For example, it's stick to the
that'd be
Google
interesting because I would guess that this would cause you to get out of positions.
Yeah, we will
maybe
check,
even get back into that position. Like,
yeah, I was checking many times. It was selling and then buying after 3 months, for example, again. Yeah, because it's all based on the total score. Yeah, how much points it gets. It's all based. It's all
totally.
about
I mean,
points.
I've for example, United Healthcare, right? I loved it, owned it for a long time, and then I sold it, and now I love it again because it's priced really well. It has revenue growth. It has free cash flow. So that would be interesting to see. Okay, good stuff.
Yeah,
keep going.
And just we can just check the results, the annual volatility of this portfolio compared to S&P 500. The Sharpe ratio is, I don't know how to explain that, but these three things, if it's higher, then it's better. Sortino ratio.
If you like me, well, the Sharpe ratio very briefly is just, and I don't remember the exact formula, but basically it tells you your expected return versus risk.
Yeah.
Because the idea, of course, as you went into earlier with your slides, is greater risk, often greater return. But with the Sharpe ratio, the idea is that it's if you have a better Sharpe ratio, if you're comparing two portfolios and only looking at Sharpe ratio, for example, like if everything else looks the same, the better Sharpe ratio means you're getting the same. I think it means you get the same alpha, you get the same gain, but lower risk. I think that's roughly.
Yeah, I know that Sharpe is about gain. Sortino is about like risk, like how much the drawdowns. Something about drawdowns. I think the Sortino was.
Yeah, it's how much risk you're taking on. Like if you're leveraged up, up the wazoo, that gives you a really bad Sharpe ratio, of course.
Yeah, that's true. So yeah, we see that max drawdown for this entire time was 59%, and the S&P 500 was 56. Yeah, 56, 59. And just remind you, this is only 5 stock portfolio. And yeah, we have, for example, the dates for the drawdown, when it was, how much it took to back on the back on this level when it was before the drawdown. So this is this, and I will just show you, for example, for every period of time. For example, in 2006, it started with buying eBay, this company, I don't know them, Google, Cox Corporation, and yeah, and tapestry. And yeah, and we see how much of every stock it bought, right? Based on this criteria, PSG ratio, for example, and correlation. And we can see for the next rebalancing, and we see that it just bought.
Cool.
Yeah, this is minus 14. It's rebalancing, so it's not like selling the stock. It's still fits in these 5 best companies, but it's we are buying, right, to make it the bigger position, because it should be bigger.
That's
yeah,
when eBay still
calculated.
owned. They still owned PayPal.
Yeah. So that was the result. And for example, this was we sold these stocks because there was better companies just with better scores. So the Google, no, not Google, SLB, Qualcomm, and North. I don't know them, but you probably know. So it looks like this, and we can check every period of time. And even we can, for example, for December 2006, we can check the scores for every company from S&P for that time. The best 5, which was from here to here, right?
Very good, yeah.
Yeah. So it looks like this, and it shows how much was the profit from here to here. It was 1%, 11, and we can just check everything. Oh yeah, for example, that was the worst, right? We see that what was bought to before Google, Occidental, because Occidental was it was very high with the points, because analysts thought that it will be growing, right? I can show you why it was in the. For example, yeah, that is a mistake. It's like every scoring model will have some bad things. For example, why it has this high score, because free cash flow was it got almost 15 points because it's low. Compared to history, was not that great. Maybe you just we'll check for the what analyst was thinking. They was thinking that it will be growing by 24%, right, during this time. But later it went down. So analysts also can be wrong, right? Yeah, just because analysts thought it will be a very good future for this company for next 2 years, and that's why it was chosen, the stock. But it showed that it wasn't in the reality, because it went down. So it happens, right? And that was the stocks were the worst chosen, because it generated minus 40%. Right? It was Google was minus 42.
Yeah, because this was during the big financial crisis.
Yeah.
Nobody got out without getting beat up.
So, but and the next 6 months it generated 4 and 23%, for example, what was bought here. No, here, because we bought here, and that's the result, right? So it's Google was in the portfolio because it's just rebalancing. It was it grown 27%, so we just sold a little bit position, and it was bought the CNX, this one, Stricker Corporation, and it generated these results 11, 26. CNX generated 59 after 3 months.
Okay.
So it's all about that, and it's combined to the end. For example, from September to December 25, it generated 36.
Very cool.
And
that rate of appreciation, is that like annualized, or is that for the quarter?
This is for the quarter because we make in this model, for example, I choose to make the rebalancing every three months. So
Okay.
it shows me every rebalancing in the history, right? I can choose like to do this every 1 month, right? Also, if you want, for example, and then you will have more data for every, or you can make for 12 months. So every year will be just rebalancing, choosing the best companies and just forget about it. And 1 year later, we are just looking, for what's going on and what to do. But it's not always the best 1 year because many things can happen during that time.
Mm-hmm. Yeah.
And just find out that free is very good for this portfolio. You can
very good.
have fun and just check it because in every in the other model, which I created, for example, every 1 month was the best option, or every 8 months it was the best. There's a guy in Poland which generated, for example, from the 2016, from now, he generated 46% of CAGR.
Wow.
And he was buying 7 companies and rebalancing every 8 months. And for now, for example, this peaks 7 best companies are Broadcom, Palantir, Oracle, MasterCard, Netflix, Meta, United Health, and something else. MasterCard, I told you, and something. But it is interesting, every model will be like different results. You can change one small thing and will be everything different. And I think this is very nice because when we are investing, we are like we are using our brains, and we are humans, and we are emotional also, and we are choosing what we think is good. But sometimes the just mathematical model will be better than us, and we will have for example, there is a very good company like Novo Nordisk, for example, and we can, for example, I bought the stock went down, but I was still checking, waiting for a rise of this stock. But maybe the model, for example, it would sell after 3 months and doing something, buying.
It would have did you a favor. Yeah, it would have helped you. But I would say that this is like investing is art and science. Science is mathematics. Like you're right that the mathematics are gonna line up a particular way, but the art is okay. Do you believe NVIDIA is going to continue to grow at the revenue growth rate that we're seeing for the next 5 years? That's the question. Because if you need to make the decision as an investor of, I believe that NVIDIA, me personally, this is my opinion. I think NVIDIA is going to keep growing this year, but it's going to have a hard time growing at the rates that it's growing next year and the year after. Okay. Because I have knowledge of the industry. I'm in technology. I work in technology. I'm working with a customer that's interested in doing certain workloads on the Oracle Cloud, and NVIDIA is one of the options for the compute.
Yeah.
So,
for example, now NVIDIA is in the portfolio, but this is for December. I created a different one when the rebalancing is in the 1st of January, so it's more accurate. And NVIDIA is still in the, but so the model is not,
But again, back to the point of like, it shouldn't be all mathematics and it shouldn't be all art. No, it has to be a combination of the two.
Yeah.
But one of the things that investors should really think about is pick industries that you can understand. You don't have to be an expert, but you have to know, like NVIDIA, do I believe that they're going to keep selling these GPUs at the level they're selling on? No, it's hard to imagine that because the cost of GPUs and the cost for Broadcom, the cost for Micron, these costs are extremely high. Okay. Right now we're in this zone where I'm like, I can't believe we're in this zone. And I'm actually seeing real hand data that's telling me, and examples where normal industries are not investing in data center, but the big ones are. Amazon with AWS, Microsoft with Azure, and they're building it just to get these large language models built, and for these apps like OpenAI and Grok, all, Gemini and so forth. And those things are kind of giving us new experiences, which is good. But what's the longevity of that growth? I think that we're going to see a pretty strong correction to that thought pattern in 2026, at the latest 2027. Now, that's the art. That's qualitative decision making on a market, and you marry it with what you're sharing, which is the math. Okay, these are metrics, these are ratios, and then you say, is this business desirable, right? Like NVIDIA, okay, definitely they're a big cash flow generating machine. They're growing, okay, good. They're very profitable. So it's a desirable business, and I actually think they're a little discounted, so I've been picking up shares. But we have to marry that with a more longer term kind of expectation. So I would say that's the difference between making a lot of money and not making a lot of money.
Yeah.
Like Google, right? Google
yeah.
was a year ago. If we were sitting here a year ago, it'd be like, man, the market's really selling off Google, like Novo Nordisk. And I thought the market was wrong. Market's wrong. Why? Google's loaded. Look at the science. Look at their sales growth. Okay. Look at their free cash flow generation. Okay. So it's a desirable business. Now, the market sold it off because the market thought, oh, OpenAI is going to put Gemini out of business and it's going to take away a lot of search. It didn't happen. To this point, it hasn't happened. It hasn't really changed Google. It's actually made Google stronger, better, faster. And that belief a year ago is a 70% rate of appreciation on a $200,000 position. So I made $140,000 with that decision in 1 year. That's the art and the science. You follow me? Like you have to have the awareness at a minimum, and maybe even some good knowledge of, do you believe in Google? A year ago, not now, a year ago.
That's completely true. That's why my conclusion was to not to just split my portfolio one to the scoring model, because there's many stocks which we would never pick because we are thinking that it's not like it's too expensive. We are not believing it will grow that much that analysts are thinking it will, for example. Like Micron, for example. In the April, I bought Micron for $70 per share,
Nice.
and I sold it, but it was but I sold it for like 128 because I was just too scared to keep it. But for example, this mathematical model can be not scared, for example. So I know that I can make mistakes, but I know that model can make mistakes. That's why, for example, I just split my portfolio, one to mathematical, from the model, and one to my reasonable human, to always gains from the advantages of human and the technology. Just that was my conclusion, because I didn't want to miss some gains which model can predict, and I didn't want to trust model that much, like in the 2008 when every company was like going down, and I just wanted to make sure that some of these human decisions are still there.